What is dividend coverage ratio? Dividends represent a company's earnings distributed to shareholders. To sustain dividends, corporations must generate sufficient cash flow to cover operational costs, debt payments, and investments. The dividend coverage ratio is a key metric used to assess whether a company can maintain its dividends using current earnings. It shows the proportion of net income available to shareholders that covers dividend payments. A higher dividend coverage ratio signifies a company's strong ability to maintain dividend payouts, reassuring shareholders and analysts of stable returns. The ratio is calculated as dividend coverage ratio equals net income available to equity shareholders / dividends paid. Net income is adjusted for taxes and preference dividend payments, and dividends are taken from the cash flow statement. A high ratio, such as 4, indicates that earnings are 4 times the dividend payments, showing ample capacity to sustain dividends. For example, Donor Limited's historical data could reveal that in certain years, its earnings were twice its dividends, reflecting an improvement in profitability and dividend policy. Comparing this ratio across companies in the same industry provides insights into their ability to sustain dividends over time, helping shareholders gauge dividend security. While useful, the dividend coverage ratio has limitations. It relies on net income, which may not always reflect actual cash inflows, so it might not provide a complete picture of a company's ability to pay dividends. Additionally, net income can fluctuate, and changes in the dividend policy could affect the ratio's reliability in the long term. To get a fuller understanding of a company's dividend policy, other ratios like the dividend payout ratio and preferred dividend coverage ratio should be considered. The dividend payout ratio shows how much of the earnings are paid as dividends, while the preferred dividend coverage ratio assesses the company's ability to meet mandatory preference dividends. Together, these ratios provide a more comprehensive picture of a company's ability to maintain dividend payouts over time.